Hey everyone, I know it's been some time, I apologize, but welcome back to another episode of Life with Kyle. Today we're going to be talking about something that I find actually very interesting just for my own personal sake. I know it's been some time since I've uploaded anything, graduated college, got a job, and then the coronavirus hit. So, what a time to be alive, right? At least I got to walk the stage. That's not a diss to any of my friends that didn't. I apologize. I sincerely feel for you guys that didn't get to, but life goes on. So nonetheless, let's dive right into it. We got a couple things we're going to take a look at. Want to look at the Buffett Indicator. Want to look at what the Fed balance sheet's been looking like. Want to look at some predictions I'm seeing for the SPY and what it looks like the market might do. Going to talk about the banks. The banks have been a big player in everything that's been going on recently. So we're going to look into that. And disclaimer right now, guys, this isn't investing advice. This is just simple analysis because nobody, it seems around me, really understands what I talk about too much. So this is my way of venting, just telling you guys what I see, what I think, and let me know what you think in the comments. I'm curious to see your analysis on it. So without that, let's dive right in. So I want to make a note of this real quick. Investing is a macroeconomic perspective that trickles down into the microeconomic perspective. Anything major can tumble markets. And this is a prime example right here. On May 2nd, 2020, North Korea and South Korea exchanged fire in first clash in years. So we look at this, it's basically just talking about how they exchanged fire, came close within war, blah, blah, blah. And you think, okay, well, yeah, there's probably war on the horizon. But take a look at what Samsung stock did the moment this aired. On the 2nd, they were going up, and then boom, the article came out, and ever since, they've been declining. Now, granted, this is relative to, the Korean exchange price. It's not in USD, but still, the concept still applies that, macroeconomics, granted the fact that there was almost a possibility of war going on, and there still is, obviously, with the stock still declining, this can indicate that, massive sell-offs occur because people are shifting investments, shifting stuff like that. So headline news is a big thing, but you have to know what it's going to correlate to. So here's the next thing I want to take a look at, the Buffett Indicator. It's the corporate equities to GDP. Basically, what this is saying is if you look here around between 1980 and 1985, the stock market, the equities market, relative to our GDP was about 32%. As time progressed, we started coming out, depressions, got better. The dot-com bubble at 159.2% of our GDP was the equities market. Tremendously overvalued. It's insane what it's at. And then all of a sudden it dropped. Dot-com bubble bursted, started climbing back up again, and then 2008, 2009 financial crisis dropped all the way back down right before 2010 at 66.7% of our GDP. That was our equities market. And ever since, it's been rocketing back up. Even with the massive decline back in 2018, we're still going up, and we're currently at 156.3%. That is why Warren Buffett came out and said explicitly, none of the stocks are appealing to him. They're all overvalued, and this is the exact indicator he's using. This is a prime indicator of why a lot of people believe the whole market is going to retest a bunch of lows because it's all immensely overvalued. That goes back to the point I was saying on my Instagram story is that you don't buy stocks when you're in the biggest recession of your lifetime and everything's hitting all-time highs. It makes absolutely no sense. And this is correlating to why everything is just rocketing up because it's all tremendously overvalued. When your RSI spikes immensely, everybody's wanting to buy. The Fed wants to buy everything. It's just going to keep going up. But how long is that sustainable? And we're going to get into that here shortly. So this is the Buffett Indicator. This is what a lot of people are saying. This is why a lot of people are saying that the market's not going to keep going up is because everything's already so immensely overpriced. The dot-com bubble, we're almost there. Like within the span of 20 years, we're back to where we were, and we've got to correct this. We've got to bring these back down. These have to come down, and it may hurt a lot of people, but this is unsustainable. So it's either just going to go up and be an even bigger bubble and burst even, more liquidity, lose more money throughout the nation, or it's going to have to slowly ease some of that pressure off because right now it's exceptionally overvalued. So the cool thing about this is I'm going to tie everything back into each other. So if we look here in 2008, when the equities market relative to our GDP was at 66.7% back in 2008 after the financial crash, things started going up. Now if we look here, the Federal Reserve's balance sheet from 2008 to the present, it has immensely skyrocketed in value. Like currently, right now, 6.5 in millions of dollars. 6.573. They put $6.5 trillion into this economy since 2008. That is insane numbers. And if that doesn't correlate to our overvalued corporate equities to GDP ratio, I don't know what is. So our Federal Reserve balance sheet is just immensely expanding. This is getting bigger by the day. This is what's determining our markets. It's not people buying. It's not people looking to buy in. That's going to have a little effect. What's having the biggest effect is what the Federal Reserve is doing relative to counteract these markets from falling. You know, the saying stocks only go up can only happen for so long. If we look, this is beginning to level off. The Federal Reserve has already came out and said back in September 19th, 2019, the Fed came out and said it might not have many tools to fight the next recession. Clearly, they had some trouble brewing. Clear sign of the Fed's concern is back-to-back rate cuts, something that only happens during recessions or in anticipation of a downturn. So either they knew the coronavirus was coming, or they were trying to hype these markets up so they could continue Federal Reserve balance sheet going up, and they could continue this Buffett Indicator skyrocketing so the stocks could keep going up, keep their value. But this was published back in 2019. And again, the Fed has come out during the coronavirus and said, we will not have enough tools to combat the next recession. So if another downturn is possible, a lot of people are going to have immense issues with their money in the market. So let's take this a step further. Okay, we're going to go over here. We've seen the Fed doing everything they have, trying to get all this money out. They're trying to stimulate the economy, whether they're doing stimulus checks, PPP loans. They need to get money to the people. And so what we have here is our global lending standards and policy rates. I covered this a little bit in my Instagram story again, but I'm going to get into it in a lot more detail, and I'm going to talk about what the banks are doing behind the scenes and why this is diverging like it is. So again, just a brief overview. As GDP increases, the global lending standards increase because you don't need to give out that much money. When your economy's doing well, you can tighten up on your loans because, you don't really need to give loans out if you're doing well. Just give it out to the people that you know can afford it. Don't take the risk. But again, when stuff collapses and everything kind of levels out, at that point, people who need the loans, who can take the loans and afford them, you probably give it to them. So you ease up on the loans, try to get some money flowing with the economy. You let people take the loans out so they can start their job, start a company if they want. But the same thing, your global GDP begins to increase, so do the lending standards again. But right now, time of the century, we have a divergence in this. For the first time in history, there's a divergence in the global lending standards and policy rates. The GDP decreased immensely. You would think, okay, we need to get money back out there. We need to have a way for people to start ramping up the economy to the extent that we need. But instead, banks are like, nope, it's going to be exceptionally harder to get a loan now. So why would banks increase that if GDP's decreased and they need to stimulate the economy? First off, I think it's immensely crazy that, not to get into so much politics about this, but let's think about banks for a second. The first people Donald Trump called upon when everything started to go down were banks. So who do you think the banks are going to cover? Themselves, clearly. That's why they haven't fallen yet. They dipped a little bit, but obviously CYA, when they met with President Trump, told him, hey, print all the money, give all this money to people, we'll hold it, we'll do it all for you, we'll approve whoever we want. And look, they just made it harder to approve whoever they wanted. So right now, corporate banks, commercial banks are governing who gets the money right now, and centralized banks are just giving it out, expecting the banks to give the money to everyone, but that's not exactly the case right now. So because of that, we'll take a look at something here. Goldman Sachs, again, brought this up in my Instagram video as well, but we're going to cover this in more detail. Every time there's been a recession, you get a dip, 2007 comes down, comes back up, 2007 hits, bam, housing crash, everything Goldman Sachs owned just went in the total trash. Oscar had his fair share from his trash can of whatever he wanted within Goldman Sachs. But now they've climbed back up, coronavirus hits, and relative to the rest of the economy, Goldman Sachs isn't suffering nearly as bad as they did back in 2008, given that this is a more severe recession, exponentially bigger than what they had in 2008. And economists across the globe have said this is nothing compared to the 2000 dot-com bubble, to the 2008 financial crisis, nothing compared. This is way bigger than all of that, yet banks aren't suffering. So again, like I mentioned, banks are going to CYA. But let's go back to the chart and let's look at something. Okay, banks aren't suffering yet. But here, we have it harder to get a loan. Could that correlate somehow? Well, let's think about this for a second. Banks are allowing consumers to defer payments on their mortgage for up to 60 days, and then so long they're going to repay it later on. The biggest issue these companies have had is you'd think, well, they should have enough money to cover operating expenses for a month. I don't get how they're all suffering. The way accounting laws work is you can base your accounts receivable as liquidity. But when your accounts receivable goes, that's it. Everything's done. And that's what's happened to all these companies. Now, these banks operate the exact same way. But what these banks are doing is because they're allowing people to defer payments and put them on at a later date with higher interest, they're allowing their accounts receivable to remain afloat. So they still look good on paper. But that's for 60 days. We've got 30 days. And if things don't get back to normal, if people don't go back to their normal jobs, if people don't go back to working their normal hours, getting their normal salary, this is going to go fast. And when this goes, that's when everything else is going to follow. So, of course, banks know that. Banks know that. That's why they're diverging this global lending standards and policy rates. Banks know that there is a huge risk. If these people don't get back to normal, we're done for. So they make the loans harder. So people at this time who think, let me get some property for cheap, take out a loan, they're not going to get approved for it. The bank's not going to risk this because if they know, hey, this guy might not go back to making his money like he's thinking, he's just going to default on his payment. That's just going to hurt us more. So banks are going to increase how hard it is to get a loan relative to this GDP because the bank's the ones with all the money right now. The commercial banks own all the money. The central banks just print it, give it to them, say, hey, hand this out for everyone. And of course, they just make their own rules for it. So there's a big dissonance right now between what the market's doing and how it's prepped up. But the last thing to go is these banks. When these banks go, if they go, that's a big if. Now, it's not really a big if, it's a big when they go. I think it's inevitable. I don't think there's any point to where society can return to any sort of quote unquote norm to where we were before the coronavirus, just because of how many changes every single industry, every single company is going to have to make to cope with these social distancing laws. So I think this is going to be a huge downturn. And again, if we look at over here, we'll just go to the SPY, for instance, the ETF. Well, look, same thing. We'll max it out. Every time there's been a recession, it dips, but it dips lower. In 2008, we'll scroll all the way back here, 2008, 2009. We'll come down. It dipped about relative, probably 10, 15% of its value, and then started coming back up. Got up about half, 3/4 the way, and then slammed down again. Came up a tiny bit and then slammed all the way down. Now this decline in the price of the S&P 500 went from 2007 all the way to 2009 for to hit its lowest low. And we're just now beginning to see the big corporate giants reveal their earnings and the damage done from the coronavirus. Disney alone took a $1.4 billion hit to their earnings within 1 month. Now, granted, they're beginning to open their Shanghai station, but that's all based on the consumer saying, hey, yeah, I'm willing to go to this massive park full of people, risk getting the coronavirus all over again, just so I can go to Disney. Now, if that plays out, that's if people now have the money to afford their season pass. Think about it again. If the work isn't there, if people are still furloughed, and if their work isn't going to hire them back for the same wage because they've taken such a big hit like this, there's no way these companies can survive. In my opinion, it's just unsustainable growth. And that's what happens. That's exactly what happened in the Great Depression. Unsustainable growth. We expanded way too fast. And look at all that Disney has done within the past 5 years. Expanded Shanghai, expanded the Orlando parks, expanded hotels, Disney Plus, all of these things. Rapid expansion within the past 5 years. That's exactly what happened in the Great Depression. So there's a reason people are saying this is worse. There's a reason the jobless claims are as high as they are. It's crazy. It's mind-boggling. So just based on everything that's happening, we've got one bounce. This looks like a dead cat bounce coming up. In my opinion, I don't see this going anywhere. There's too much downward momentum. There's too much negativity still focusing. And when you look at the Buffett Indicator with how priced everything is, when you look at the economics of the situation, the macroeconomics, and how it trickles down to the single worker on the scale, it's not sustainable. It's just not. It's going to fall. So watch this closely, guys. This is a little bit more in-depth of what I was covering on my Instagram story. Speaking of which, if you want to follow me and keep up with some of the posts I do, click the link here to go to my Instagram profile page. And same thing on my Snapchat. Snapchat covers more cryptocurrencies, so I like doing that a lot. Cryptocurrencies are 24/7. I firmly believe that's the trading of the future, but there's a fast game to that, and it's like you're literally watching stuff move 24/7. So if you're interested in that, stay tuned. Here's my Snapchat as well, so you can watch some of the stuff I post on there. But yeah, guys, this is something I'm personally interested in myself. These are some of my thoughts that go through my head when I'm looking at these stocks. I'm like, how can they keep going up and hit all-time highs during the biggest recession in history? Jobless claims going up through the roof, and stocks still go up. Makes absolutely no sense. But look at the Fed's balance sheet. Makes complete sense when you look at the Fed's balance sheet. They're just going to keep going up. They don't have anyone to fight anything, but boom, we can just keep pumping money into it. But how sustainable is that? The Treasury just came out with a 20-year bond where it plans to borrow $3 trillion in the second quarter for rising stimulus costs. I don't think it's going to be anything good anytime soon. Be mindful of it. Make your own assumptions, but let me know in the comment section what you're thinking. Whether you're bullish or bearish, don't belittle the other guy for being what he is. Understand everyone's perspective and take their opinion with a grain of salt. But make your assessments on your own. You can't just see a chart and say it's going to go up without having a reason for it just because it is going up. You can get lucky on that, but if you don't understand the economics of what's happening, what these major companies are doing, how these earnings are beginning to show the bigger picture of how vastly impacted. If Disney took a $1.4 billion hit, imagine what every other single company took relative to their size. Imagine that. So keep that in mind, guys. This is, I guess, an intense episode of Life with Kyle. It's something I'm passionate about, something I'm really, I see it long term, and I want to see, what investing looks like, but keep your eyes peeled. Don't believe every single thing you see on the news. Look at it, make your own assumptions, start connecting the dots. So, all right, guys. Well, that's all I've got. Just wanted to cover some of those things, what I think what the banks are doing. But we'll discuss more stuff later on as time progresses. But that's just something, I think people need to know. This is something I wish I would have really started researching before I started investing. It would have been much more exponential for, my investing career. But granted, I'm getting into it now, and I'm sharing this with you guys. So if you have any questions, send them in the comment section below. If you got any suggestions, stuff I should look at, let me know. I'll put that in there as well. I'd love to get videos out. This is like nothing for me. I can watch this 24/7 because I enjoy it that much. It's not work. So anyways, guys, thanks so much for tuning into Life with Kyle. This is an investing segment. We're looking more at the market side. So this is for those who want to get a little interest in the stock market. Now that stocks are starting to hit lows, might be the perfect time to buy in and just hold, let some money sit on it. So we'll watch this, guys, and we'll catch back up some other time. Thank you so much for tuning in. If you're new, like, subscribe to the video, comment, let me know what's up. Other than that, we'll convene next time, guys. Take care, stay safe through these times of coronavirus.